Welcome back to Investing Talk Podcast. We are so glad you're here for another session where we really get into a fascinating company. This one's involved in high-tech subsea robotics. Today, we're unpacking Nauticus Robotics. We've got a good amount of information here, financials, strategy, where they sit in the industry. The goal is to cut through the noise, give you what you need to know. Before we get started, if you find these explorations valuable, maybe take a second to subscribe, perhaps leave a like or a comment, and, consider buying us a coffee. Your support really does help us keep this going. Okay, so Nauticus Robotics. What exactly is this company doing, and maybe why should you be paying attention right now?
Right. So Nauticus Robotics is based down in Houston. They develop autonomous subsea robots and also cloud software solutions for, well, the ocean industries. Think of them as trying to build the next generation of, let's say, underwater explorers and workers, bringing AI and robotics to the ocean depths.
Okay, that's interesting. What's their business model look like? Is it just selling robots, or who are they selling to?
It's actually pretty diversified. They do robotic services, so like operating the robots for clients. They also sell the vehicles directly, and they license their software. Target markets, commercial side, definitely offshore energy. That includes oil and gas, but also, importantly, offshore wind farms. And then there's a pretty significant defense angle, too.
Defense, okay. Makes sense for underwater tech. So what makes them stand out? What are their key products or technologies?
Well, they've got a couple of core things. First, there's the Aquanaut. That's their flagship product. It's a fully electric, autonomous underwater vehicle. The big deal is it's designed to be much more efficient than the traditional robots that are tethered to a ship.
Right, those big cables going down, so untethered and electric.
Exactly. Think less like a remote control car on a string, more like a self-driving vehicle underwater.
Okay, that's the hardware. What about the smarts, the autonomy part?
That's where tool KITT comes in. That's their advanced AI software platform. It's really the brain behind the Aquanaut. It lets the robots, see their surroundings, navigate on their own, make decisions, carry out complex jobs with minimal human input, really pushing that autonomy envelope.
Okay, tool KITT. And you mentioned doing complex jobs.
Yes. For the really intricate stuff, they have something called the Olympic arm. It's a patented, fully electric subsea manipulator arm designed for precision, dexterity underwater.
So autonomy, electrification, that seems to be the core theme. Why is this approach so important right now, particularly for industries like offshore energy?
That's a really good question. Why now? Well, the whole offshore robotics sector is seeing this big push for automation. Companies want solutions that cut costs, obviously, but also lower emissions, getting those big support ships off the water and massively improve safety. Sending people deep underwater is risky. Nauticus is positioning itself right in the middle of that trend, saying our AI-powered vehicles and software can do this cleaner, safer, and potentially cheaper.
Okay, positioning makes sense. And speaking of positioning and strategy, they made a big move recently with an acquisition, right? Tell us about Seatrepid International.
That's right. On March 20th, this year, 2025, Nauticus completed the acquisition of Seatrepid International. This was a pretty significant step. It really boosts their operational capability, gives them a much larger footprint.
How so? Just more robots? Or is there more to it?
It's more than just adding assets. The strategic plan is to integrate Nauticus's core autonomy software, tool KITT, across Seatrepid's existing fleet of ROVs, remotely operated vehicles. So the idea is to make Seatrepid's established fleet smarter, more efficient. They hope this will speed up deploying their tech and maybe offer some industry-first efficiencies by, combining their Aquanauts with Seatrepid's resources and customer relationships.
Ah, okay. So leveraging the existing infrastructure of Seatrepid, but upgrading it with their own AI. What's the expected impact? Management must have high hopes for this.
They definitely do. Management expects this to be a major growth driver. They've actually said they anticipate surpassing their entire 2024 revenue just within the first half of 2025.
Wow, that's ambitious.
It is. And they say it's primarily because of the Seatrepid integration. They're also reporting a positive market response already, expanded service offerings, increased customer demand since the deal closed.
Okay, ambitious targets. We'll need to see if they hit them. Let's talk numbers then, because that's often where, the rubber meets the road for investors. How did Nauticus actually perform in Q1 2025, especially with this acquisition happening mid-quarter?
Right, the numbers. Well, Q1 is interesting. A bit of a mixed picture, really.
Mixed how?
Well, Q1 revenue came in at $0.2 million.
$0.2 million. That sounds quite low. Wasn't it higher before?
It was. It's actually down from $0.5 million in Q1 2024. So yeah, about a 64% drop year over year. But And this is important. That's before the SeaTrepid acquisition could really contribute meaningfully to the revenue line. That deal closed late in the quarter.
Okay, context is key there. But what about profitability? Any bright spots?
There is, actually, on the earnings per share, or EPS front, it showed a pretty substantial improvement. They reported a loss of $0.28 per share in Q1 2025.
28 cents loss. Okay, how does that compare?
Well, it compares very favorably to Q1 2024, where the loss was a, frankly, staggering $58.75 per share.
$58 to 28 cents. That's a massive swing. How does that happen if revenue is down? Is that purely operational or something else?
That's the critical question. It's not just operational efficiency driving that huge EPS change. You have to dig a bit deeper. A big chunk of that massive loss in Q1 2024 was due to a non-cash warrant liability adjustment. And crucially, they did a 1-for-25 reverse stock split back in November 2023.
Ah, the reverse split. So fewer shares outstanding makes the loss per share look smaller, even if the total net loss didn't improve quite as dramatically.
Precisely. It significantly reduced the share count. So while the smaller loss per share is positive, you need to understand the mechanics behind it. It's not purely organic operational improvement reflecting that whole jump.
Got it. So it's still unprofitable then, which means things like price to earnings ratio are kind of meaningless at this stage.
Correct. You can't really use PE. And return on equity is likely negative too, given the ongoing net losses. They're still very much in the investment and growth phase.
What about cash? Did they have enough fuel in the tank, especially funding an acquisition?
They reported having $10.1 million in cash at the end of Q1. And importantly, that was after raising $19.4 million by issuing new shares earlier.
Okay, so they did a capital raise. That shores things up.
Absolutely. That capital was essential to support growth, including funding the SeaTrepid deal and giving them operating runway.
And are they getting new business? You mentioned positive market reaction post-acquisition. Is that translating into actual contracts?
It seems to be starting to. They've announced securing some new long-term contracts, some for at least 120 days with international energy companies. So that suggests some stable near-term revenues coming in. Management called it a strong start to 2025, especially now that their main offshore operating season is ramping up. They've got deployments happening in the Gulf Coast and up in New England.
Okay, new contracts are good. In this whole subsea robotics space, though, it feels crowded. Where does Nauticus fit in? Are they a leader, a niche player? What's their unique angle?
Yeah, it's definitely competitive. Nauticus positions itself more as a challenger, an innovator, rather than an established leader, mostly because their revenue base is just much smaller than the big guys. Their key advantage to their unique selling proposition really comes down to that proprietary tech Aquanaut. The robots themselves, like Aquanaut, and especially the autonomy software, tool KITT.
So it's the tech differentiation.
Right. They emphasize the full electrification and the AI-driven autonomy. That's different from many competitors, like, say, Oceaneering International or Saab CI, who still rely a lot more on conventional hydraulic systems or tethered ROVs.
You mentioned electrification being key. What are the actual performance benefits of electric versus hydraulic underwater? Is it just cleaner or more?
It's quite a bit more than just being cleaner, although that's a plus. Electric systems tend to be more precise. Think finer motor control, which is great for delicate tasks. They also generally require less maintenance, no hydraulic fluid leaks, fewer complex hoses. That means less downtime, lower operating costs potentially, and they're quieter. Much quieter, which can be a huge advantage for certain applications, particularly defense where stealth might matter.
Yeah.
So yeah, precision, reliability, lower noise profile.
That makes sense. More precise, less hassle. But even with cool tech, what are the big risks they're facing? You mentioned it's capital intensive.
It absolutely is. Scaling hardware is expensive. So risks. Well, first, technology risk. Competitors could leapfrog them with even better autonomy or maybe cheaper solutions. Then there's regulatory risk changes affecting offshore work, could impact demand. Capital intensity, as we said, is huge. They need cash to grow. And potentially customer concentration risk. If they rely too heavily on just a few big contracts, losing one could hurt significantly.
Okay, tech risk, regulatory, capital needs, customer concentration. How do they stack up against those big players you mentioned, Oceaneering, Technip, FMC, Fugro, in terms of sheer size and, maybe more importantly, profitability?
Well, in terms of scale and revenue, there's really no comparison right now. Nauticus is much, much smaller than those giants. They have global operations, decades of history. However, the potential upside for Nauticus is growth rate. If, and it's a big if, but if those post-acquisition synergies from C-Trepid really work out quickly, they could potentially grow faster in percentage terms than the overall sector, just because they're starting from a smaller base.
Right, the law of small numbers.
Exactly. But profitability is the key difference. Their metrics are way below the big players. Because Nauticus is still posting operating losses, the incumbents are generally profitable, mature businesses.
Okay, that contrast is stark. Let's turn to the market's view. How is Wall Street reacting to all this? What's the stock price been doing, and what's the general feeling among analysts?
Yeah, the market reaction has been, well, pretty muted, actually, despite the acquisition news. As of June 20th, the shares were trading around 94 cents.
94 cents. Where does that sit historically for them?
That's near their recent lows, around 82 cents, and way, way down from their 52-week high, which was over $6, $6.22. So it's been a rough ride for the stock.
A significant drop.
Definitely. There's been some volatility, like it popped up almost 4% one day recently, June 9th, but the overall trend has been firmly downward.
So the operational story about integration and contracts isn't resonating in the share price yet. What are analysts saying is the reason for that disconnect?
Current analyst sentiment is still pretty negative, largely because of that weak stock performance trend. There was actually an upgrade recently, but it was only from strong sell to sell.
So still bearish.
Still quite bearish, yes. It reflects skepticism about a near-term turnaround, even with the positive business developments they've announced. Analysts seem to be waiting for concrete proof of sustained revenue growth and a clear path to profitability, perhaps concerned about cash burn or potential future dilution.
What about online chatter? Social media, Reddit forums. What's the vibe among individual investors?
It's very mixed, as you might expect. You see definite optimism, people pointing to the new contracts, the potential of the tech, especially after the C-Trepid deal, excitement about the innovation. But then you also see a lot of frustration and skepticism because the share price just keeps languishing despite what looks like good news operationally. It highlights that gap between company progress and market perception. And, it's always a good reminder for you, the listener, to be cautious with online rumors or sentiment. Always do your own verification.
Good advice. Okay, looking ahead then, what are the biggest opportunities for Nauticus now? What could really act as a catalyst for growth?
The number one opportunity, without a doubt, is making that C-Trepid integration work smoothly and effectively. That expands their service capacity, gives them access to more clients, more operational reach. A really significant catalyst could be if they prove KITT, their software, is scalable not just on C-Trepid's fleet, but potentially across third-party fleets too.
Licensing the software more broadly.
Exactly. If they can integrate KITT onto other companies' ROVs, that could open up major, potentially high-margin software and service revenue streams. That's a different, maybe more scalable model than just operating their own hardware. And of course, their improved financial position after the capital raise gives them more runway to pursue these growth initiatives.
Okay, software scaling is a key opportunity. On the flip side, what are the key risks investors really need to keep an eye on moving forward? What's the main hurdle?
Well, despite the operational steps, that persistently weak stock price really flags ongoing investor concern. It could be about profitability or execution or both. The biggest single risk is probably execution risk. Can they successfully integrate C-Trepid, manage its larger operational scale, and drive those synergies they're hoping for, all while still burning cash? That's a tall order. Continued net losses are a major risk, obviously, and tied to that is the potential need for more capital down the line, which could mean further dilution for shareholders.
So execution on the integration and getting towards profitability without needing too much more cash seems critical.
That sums it up pretty well. That's the tightrope they're walking.
So pulling it all together, what's the takeaway for someone trying to understand Nauticus Robotics right now?
I'd say Nauticus remains a, high risk, potentially high reward situation in this subsea robotics space. They're showing better cost control. They made a bold strategic move with the acquisition, but they were facing really steep revenue declines before that deal closed, and they still need to prove the turnaround. The success of integrating C-Trepid is absolutely pivotal. If those expected synergies kick in and drive revenue recovery in the second half of 2025, that could be a real turning point. For anyone interested, you need to watch their liquidity very closely, monitor the execution risks around the integration and winning new business, and constantly benchmark their progress against those much larger established players in the sector. It's innovation versus incumbency, with a lot riding on execution.
So there you have it, our look at Nauticus Robotics. A company clearly pushing the boundaries in an underwater autonomy, making aggressive strategic plays like the SeaTrepid acquisition, but still facing very real hurdles around profitability and convincing the market. It really exemplifies that challenge, doesn't it? Having exciting, potentially game changing technology, but facing the tough realities of scaling up, integrating acquisitions, and competing in a capital hungry industry. What stands out most to you after hearing all this? Is that technological edge truly enough to overcome the financial pressures and the market's current wait and see attitude? Something to think about how disruptive tech battles established methods, creating both opportunity and considerable risk. Definitely something to mull over.